Hi, welcome to this live episode of Living and Working Abroad show. Welcome to today's episode where we're looking at a number of things with our main topic being on transfer pricing. And transfer pricing is increasingly a big issue for expats living and working abroad. Depending upon the size of your business. And the business could be a trading business, or it could be a rental business, or any sort of cross-border business that could be a consideration. So we're going to have a quick look at that, see how that affects expats. But before that, we'll do a news and topical issues of things, expat issues that are coming up in the news over the last week. And then if you've got any questions when you're listening, either on our Twitter space or on our YouTube live webinar, you can leave a message and we'll get back to you and answer those questions and answers as we go along. Welcome to this week's episode of Living and Working Abroad show. We're offering advice to expats living and working abroad, families and business across board and down generations. So we see ourselves as a family office and want to help and support expats doing that type of work and that type of lifestyle. A couple of bits that have been in the news over the last week, and whenever you look at UK news in particular, but any sort of journalistic news is often driven by vested interests. So whether it's a business or whether it's a politician or political party, they're trying to hold their sway for their point of view. And this is what you consider. So a couple of things that have come up this week that we see in the local media. First of all is about inheritance tax, the threat of inheritance tax. Actually, it's nothing new. The inheritance tax affects every family in Britain, or every person that owns fixed assets in the UK at their date of death. And there's a personal allowance of £325,000 that can be handed over on death. The issue that has been raised in the press is the fact that that is been fixed and it's not going to change anywhere between 2020 to 2028. So the nil rate band of 325,000 has been limited so that with the price of property and shares going up year by year, more and more families are being caught up in the internet inheritance tax bubble as it goes along. They're projected to have a 63% increase in the inheritance tax take before 2028. And this is a tax that's charged on an estate. So if somebody dies and there's an inheritance tax liability, that inheritance tax is payable within 6 months of death. Now, on first death between a married couple, there are exemptions. So the £325,000 allowances between parties that can be passed to the next person. There's also an additional property allowance. So a family could pass up to £1 million on first death of a married couple to pass over on second death. But beyond that, then inheritance tax will start applying. But when a terraced house in London can cost £1 million, it quickly starts to add up. And if you've got £1 million that is liable for inheritance tax, that's £400,000 that needs to be paid before probate is granted and within 6 months of the date of death. So it's a big issue if you've got that liability, and if you haven't got the resources in the estate to be able to meet that tax bill without penalties and liabilities. And this is where Proactive Family Office can come in, because gifts can be made during a lifetime to reduce the amount of tax that's charged to inheritance tax, to reduce the amount of the estate, so families can give to each other, and potentially that gift can be exempt after 7 years, free of inheritance tax. It's a progressive thing. So with a long-term plan, you can create a family trust to hold assets to pass to your next of kin. Once in a family trust, there is no inheritance tax that's be chargeable on that asset when that passes. Now, there's restrictions on and taxes that are applicable to trusts in the UK. However, Cyprus International Trust doesn't have any taxes for expats on worldwide assets. So there's a potential to transfer business, investment, and property assets into a Cyprus International Trust and avoid inheritance tax in the long term. What you can't do is avoid the liability on your deathbed. So if you've not made any planning and you're about to die, then the inheritance tax liability is going to come knocking on the door. If you plan ahead and make those gifts, you can retain control and give to the family, and the family can enjoy it down the generations. So for more information and guidance on how to protect your family's wealth, wherever those properties and investment assets are around the world, contact us at proactpartnership.com. Another headline in the news recently has been complaining about Brexit and the restrictions it's giving on people staying in Europe in their holiday home. This is nothing new. This is EU legislation. This is EU Schengen zone legislation and restrictions that have always been applicable since the Schengen zone was first introduced, and have been refined and updated in 2019 and 2021. So the EU will apply the Schengen zone short stay rules for residency throughout any EU country that's in the Schengen zone, and other countries that are in the Schengen zone, which some are in Europe and some are outside Europe. For more information and guidance, look at our website at proactpartnership.com, where we've got a feature on residency in the Schengen zone. Schengen zone is looking to be expanded. Croatia joined it this year. Romania and Bulgaria are close to joining it, and Cyprus wants to join it, but is not a member yet. But those short stay rules apply for EU and Schengen zone countries, which means that you're only entitled to be in the country for 90 days in any 6-month period. Now, this is a protection against criminal, police, or court actions for tax evasion. That's what it's for. Is to make sure that people pay a fair amount of tax, either in their home country or the country of residence, and they do this by restricting the movement of anybody that is not an EU citizen or got a right to live in the EU. So the Schengen zone, the EU allows freedom of movement. Freedom of movement is not necessarily the same as not paying taxes or breaking the law, moving people, moving drugs, moving criminal activity. All those things are designed to be protected. And the rule that applies within the Schengen zone is that you can't spend more than 90 days in 180 in an EU country. So this is nothing new. It does impact British people post-Brexit, because the UK is no longer in the EU. Therefore, it can't be part of that. But if the UK had stayed in the EU and Brexit hadn't occurred, it would still have had to either join the EU Schengen zone like Romania, Croatia and Bulgaria, or apply to join like Cyprus, or choose not to join at all like Ireland. Now, between Ireland and the UK, they continue to have freedom of movement between the two countries, dating back to the 1940s Ireland Act. But for every other person that's not got this special Irish-British connection, you still have to have an entry visa coming to Cyprus if you want to stay more than 90 days, i.e. longer than short-term stay. So although Ireland has not joined the EU Schengen zone, you've still got that a short stay restriction rule applies if you're not from the EU or you're traveling into Cyprus and you want to stay for more than 90 days. The answer for anybody who's got a holiday home that wants to spend more than 3 months in any 6-month period is to get a visitor's visa or a resident permit. And that's where the complication comes in. If you have a visitor's visa and you're out of the country for more than 3 months, technically the visitor's visa is automatically revoked. If you have a resident permit, then EU countries are now applying requirements like having cash in the bank, 10, 20,000, or annual income of 25, 30,000 to validate the residency permit. So to move beyond the short stay restriction for the EU and the Schengen zone, you have to be able to validate that you can afford to live there on a long-term basis. What that doesn't support is people that want to spend 4 months at a time in a holiday home in France or Spain or Portugal or Cyprus. What it allows you to do is have spring in Provence and autumn in another country, but not more than 3 months at a time. So a British expat could have 3 months in Spain and then 3 months in France straight after that, but they can't have 4 months or 5 months in Spain or or in another EU Schengen zone country. So Cyprus is not in the Schengen zone at the moment, so that general rule doesn't apply. But the Schengen zone countries, which is all the EU countries plus a few others, so includes Switzerland, Iceland, and Norway as well. You're always going to be restricted to that 90 and 180 days. For more information and guidance on your residency, visitor visa or residency permit that you need to support your lifestyle living and working abroad, contact us at proactpartnership.com. The other big issue in the news at the moment is tax return season. So UK tax returns are due from the 6th of April and paper returns by the end of October. So we're busy completing those for our expat clients. So any expat who's got UK capital gains arising or fixed income such as property rental income or going forward government service pensions, if requested or if they've got taxable income from the UK, those expats have a UK tax return, and Proact can help and assist with that. For expats that are living in an annual tax return country, then it's coming up to the close of the season. With Cyprus, they were delayed through their own technical and legal reasons, so we've got an extension to September. But any expat who needs help and guidance on completing their annual tax return for 2022 can contact us at proactpartnership.com. In Cyprus, we keep emphasising to expats, if you've got a taxable income liability that's not taxed at source in Cyprus, then you're supposed to do a self-assessment in July and December each year and pay whatever tax is due. And you should pay at least 3/4 of that bill each year. So this is something we consistently advised over the years, and clients do fall foul of that. If you don't pay in those small windows, then you can only pay the balance, possibly even when you do the tax return for the full year. So it's only since July, the middle of July 23, we're able to complete the full tax return for 2022. And those tax returns, if there's a balance, once that tax return is submitted, you can then pay the balance of tax that you could have paid or should have paid under self-assessment in 2022 for that income. And that could lead to penalties and taxes. So if you're uncertain about your Cyprus or UK tax position as an expat living and working abroad, contact us at productpartnership.com. Now, onto the joy of transfer pricing. Now, this isn't a core issue for Product Partnership as tax advisors to expats living and working abroad, but transfer pricing is all about cross-border business. So if you're working with more than one business across border, either as a personal service company or any other means, then potentially you need to consider the implications of transfer pricing. The purpose of transfer pricing is to stop a profit from business being invoiced out of one country to be taxed in other low tax countries. So if you're in the Middle East, what they don't want you to do is transfer out all your profit from the UK, where corporation tax is 19 to 25%, to pay zero tax in the Middle East, or 12.5% in Cyprus. And this is the issue around transfer pricing. So it's designed and under the auspices of the OECD to give a fair tax treatment for those countries around the world. And that's what it's about. The different ways to deal with it and different considerations that you need to take. But a connected business will be one where there's a 25% common shareholding. So if you own two companies, either as a personal service company where you're an individual tax resident in one country and trading out of another, that could be a related business transaction. Or if you own two corporations in two different companies, that too can be a related business. Transfer pricing rules have sort of come in and been updated in 2023 in many countries around the world as the OECD bring in additional provisions. For Cyprus, from 2023, transfer pricing rules applies for turnover in excess of £750,000. So it's a lot of money, but it's not a lot of money for some businesses. In the UK, transfer pricing can have an exemption for small and medium-sized companies. So small and medium-sized companies might have less than 50 employees and less than 10 million turnover. So there's quite a lot bigger exemption that can apply for a UK company that's operating as a small and medium company and applying for those transfer price exemptions. But for Cyprus, if you've got a company or an individual that's tax resident in the UK and they're trading with themselves or a related company, then at a relatively low level, transfer pricing rules can come into play. And what that means is that there's an additional reporting requirement to maintain local files or central files for the whole group to document and summarize that there's fair treatment and that there's not a tax avoidance or tax evasion issue going on by transferring profit from one jurisdiction to another. In Cyprus, any individual or who's trading as a sole trader with a significant turnover over €80,000 or any company at all, they all have to go through an audit. And in the UK, audits don't apply until turnover exceeds 5 million. But in Cyprus, it's all businesses. So the audit is already there. And the transfer pricing reports are in addition to that need to be done alongside the audit and the report. So for UK expats or expats coming to Cyprus, you need to be aware that there is this audit requirement on all businesses or all contractors with significant income that's being earned in Cyprus. For more information, guidance on that, contact us at projectpartnership.com. The best way, the simple way to deal with transfer pricing is very, very simple. It's just that you set up a framework for your business, because Proact primarily focus on smaller businesses. As long as your business has got a consistent pricing approach for individual contracts and that it provides, so you charge the same price in two different countries, and you're not charging an hourly rate of 50 euros in one country and 250 euros in the next country. Whatever your hourly rate is, you make that consistent, so that the pricing of the related businesses across border can be compared and be seen to be the same. It's a simple, consistent way to do that. And to make sure that there's a constant profit charge, and there's a fair amount of tax that's paid in each jurisdiction. You then get a consistent approach applied to your business year after year. Even though you've got distinct business where you might have a company in one country, a sole trader in the next country, or an active trading company in one business, but a licensed operation in another country, taking royalties and license fees from that business. It's clear and it's consistent, and there's that regular flow of income from that, which can be summarised clearly in the documentation. So you can still plan to reduce the total global tax liability of the business, but it's done in a fair and equitable way that can be backed up with the evidence that you've retained the records, and you're not trying to transfer profit out to a zero tax regime and avoid any tax at all. So at the moment, I don't have any questions that have come from today's live webinar, but thanks very much for listening. So what I'll do now is we'll just summarize what we've said today. In the news, there's a lot about inheritance tax and it going up, but that's because the tax allowances for UK inheritance tax have been fixed through to 2028. So over the next 7 years, if you do nothing, then your inheritance tax liability for your family will increase. But using a family office like Proact, you can potentially transfer assets out and avoid 40% inheritance tax, saving 400,000 on every £1 million of investment in property and business assets that you have for your business. We talked about as well. We talked about Brexit and how it's not quite what it seems. So some people complain about Brexit and short stay rules, but the Schengen zone applies those short stay rules irrespective of Brexit. So UK citizens would have been subject to those rules anyway if the UK didn't join the Schengen zone. The freedom of movement still wouldn't have existed in quite the same way. So if you need help and assistance with the visitors visas or resident permits, contact us at projectpartnership.com. Tax returns are now due. If you need help and guidance, contact us at projectpartnership.com. Next week, we're going to feature the new golden visa rules and regulations for Portugal. Again, this will feed into the changes being implemented by the EU as a result of the OECD rules and the changes to strengthen up the Schengen zone and the short stay rules, and get more profitable investment based expats moving away from real estate investment into business and job creation. So contact us and see our YouTube channel for the Living Working Abroad show next week, as well as live news and updates. Thanks a lot for listening, and we'll see you next time.